Creating a trading plan and trading it might seem to be simple. But if you want to make a real go at trading, it's often a much more involved task. Simply turning up and trading a strategy may work sometimes, but in order to achieve a level of consistency over the long run, you really need to put in a little bit more effort than just that. And trading is like any endeavor that you want to pursue. Those who sustain long-term success are those who are thoroughly prepared long before they enter the arena. And while you must focus on the process and not the goal itself, one thing that's vital to both, and that is that the devil is really in the details of everything. And you're going to see people who are either using an off-the-shelf strategy, they've picked something out of a book, or perhaps they try to follow some strategy from a well-known and perhaps successful trader that's on the internet. And frequently, you're going to see these people fail, and it's not a coincidence. There's nothing wrong in particular with doing any of those three things, and indeed, the information that's out there is pretty good in some cases. But if you don't really consider and test and refine and sim trade your strategy, any number of things really could end up being your downfall. For example, some guru with a strategy which works really well for them could have missed out on a couple of really crucial details, or you could have missed them yourself. Our brains have a habit, when faced with lots of information, skipping over details, which it doesn't immediately recognize as being important. And they may not be particularly good at teaching others, and that's something which may well not be apparent right at the beginning. They may also use a discretionary element from their years of trading experience to achieve the results they've gotten. Now, what about those off-the-shelf trading strategies? And it might only work well on specific markets or during periods with certain market conditions. Who knows? But the fact is that markets change, and so strategies, at the very least, the application of the strategy, may need to be adjusted over time. So there are many potentially unforeseen factors which could end up being detrimental to a strategy if you're not careful and on the ball all the time. Now, there are some things that you can do to increase the odds that the plan that you're using is viable for the markets. Now, make no mistake, all the traders you've read about that have some level of success that you seek, they have a trading plan that they follow. Number one, know your system like the back of your hand. And your system can't just be a bunch of lines and trading indicators on your charts used to generate signals which, in theory, have been historically profitable. You must understand what it is you're trying to take advantage of in the market. And it could simply be a trend, a breakout, or a range, for example. You also need to know when your strategy is not effective. You also need to know why certain sequences of price movements trigger your entry signal. You need to know what to expect from the market after your entry from both winning and losing trades. Do all the winners, for example, come when the market goes fast in your direction right after your entry? Or does that even matter? Does it work well in quiet markets? Or are the fast-moving market conditions the most effective for it? Does this then lend the system to perform better in something like the euro dollar, not the currency, but the tortoise, or something more like the DAX, which is like the hare? Number two is know your plan like the back of your hand. Being able to execute is not just about being quick on the draw. It's about understanding the adjustments to your strategy which you're willing to make and reading the markets in real time in order to know when to make them. And this might sound straightforward to you, but in the heat of the battle, if there's any ambiguity in your plan, emotions are likely to take over, and the consequences of this could be disastrous. And I just want to add here that I don't believe that emotions are bad. It's acting with emotions that's potentially harmful to a trader. And it's also knowing which time of day to trade it, knowing how many contracts to trade with, being fully aware of any economic releases, and so on. Third, you want to test it. There are many considerations which you may need to make, and then comes the need for testing. Back testing, manual back testing, and then simulated environment testing are important. It's important to do more than just automatic back testing, in my view. For example, you might not get all the fills where your back test has indicated trades were taken. And this might not actually affect the results too much, or it could really make a critical difference to them. If you don't test a theory, at least test it. And preferably the strategy itself. How are you ever going to know whether it's worked before? And how will you have the confidence to execute live trades in the products that you want to trade? If you trade the system randomly or based on your gut feel, there's a chance you're going to end up picking all the losing trades in an otherwise fantastic system. Have you ever watched the market when you've been lacking your confidence? And finally, after a series of what would have been really good winning trades, you've mustered the courage to take the next trade and you pick the loser? Number four, you want to sim trade it. Now, when I mentioned simulated testing earlier, I'm not talking about some fill on touch simulator. These are a complete waste of time. You need to use a simulator which is fast and has a queue algorithm to properly simulate the fact that in a real market, your order may be behind a large number of other ones already sitting at your limit price. That could make a huge difference to your results. You must also test it for a sufficient length of time and number of trades. Having a couple of winning days in a row and saying, well, that works, so I'm just going to go for it, that's not a really good idea. There's going to be winning and losing streaks in any strategy to one extent or another. And you got to expect the unexpected. Number 5 is you want to refine it. And I'm not talking about making a whole heap of automated optimizations here. What I'm saying is look through your results and individual trades, if necessary, to see if there are any logical refinements you need to make to your system or your plan of how to trade it. And then retest the trades that you've taken. Then if it still looks good, retest the data you've already back tested. You can't just guess that a refinement that you make will end up being a good one, so you have to check it. Then you got to sim trade it all over again. Now, I don't want you to think that just because you might be able to slap down $100,000 or something that you're immune from needing to go through this process. Hey, I got plenty of money to play with, and learning by trading live has got to be the best way. Well, 100K can turn into 99 cents pretty quick if you're trading more than a very small amount of contracts. Think about it. The big banks and the funds, they trade millions or even billions of dollars worth of trades at a time in some of the very same markets which you, the relatively inexperienced trader, are starting to trade. We've all come to the realization of how important the supporting work in trading is at some point, so make sure you do it now rather than later. Up your chances of finding success trading options with your free 6 breakthroughs to winning at options report. Straight from the mouth of an options trading veteran, you are going to learn his plan of attack when looking to take a position. He also wants to share his top 15 names to trade, so you no longer will be spending hours chained to your desk poring over the many choices that are available. Just click the link, enter your email address, and you'll get immediate access to this highly specialized options report. Totally free.